Welcome everyone! In this lesson, we'll be diving into the major asset classes that make up the financial markets, including Forex, indices, commodities, cryptocurrencies, equities, and bonds. By understanding how each one works, you'll gain insight into how investors diversify their portfolios and manage market risk. Let's start with the basics. What exactly is an asset class? An asset class is simply a group of investments that behave in similar ways. For example, stocks move differently than commodities, and bonds respond differently to interest rates. The main benefit of understanding asset classes is diversification, spreading investments across different types of assets to reduce overall risk. First up, the Forex market, also known as the foreign exchange market. This is where currencies are traded, and it's actually the largest financial market in the world, with more than $7 trillion traded every single day. Traders here buy and sell currency pairs, like the euro and the dollar or dollar and the Japanese yen, depending on which they think will gain in value. Forex prices are influenced by interest rates, inflation data, and even political events, making it one of the most dynamic and liquid markets to trade. Next, we have indices, which represent a basket of stocks designed to measure the performance of a particular market or sector. The S&P 500, for example, tracks the 500 largest U.S. companies, while the Nasdaq 100 focuses on tech-heavy stocks. Indices are a key way for investors to track how entire markets, not just individual companies, are performing. Moving on to commodities, these are physical goods like gold, oil, or wheat that are traded in global markets. Commodities often act as a hedge against inflation because their prices rise when the cost of goods and services increases. Investors often include commodities in their portfolios to balance out risk from traditional assets like stocks. Now let's talk about the new kid on the block, cryptocurrencies. These are digital assets that operate on blockchain technology, meaning they're decentralized and not controlled by any government. The most well-known examples include Bitcoin, Ethereum, and Solana. Cryptos are highly volatile. Prices can rise or fall dramatically in a short time, but they also offer exciting opportunities for innovation and growth. Next up are equities, or stocks. When you buy a stock, you're essentially buying a small piece of a company, and with that comes the potential for profits and dividends. Equities are central to most investment portfolios because they offer long-term growth potential. Now let's turn to bonds. These are loans made by investors to governments or corporations. Bonds are often seen as safer investments because they provide regular interest payments, known as coupon payments. However, bond prices move inversely to interest rates, meaning when rates rise, bond prices fall. Bonds are essential for balancing risk and providing stability in a diversified portfolio. So to wrap things up, every asset class behaves differently under changing market conditions. Forex offers liquidity, equities provide growth, bonds deliver stability, and commodities hedge against inflation. Cryptos add innovation and high risk-reward potential. The key takeaway? A well-diversified portfolio combines several of these asset classes to achieve both growth and protection. Thanks for watching.